Hello, and welcome to RiskOut's webinar, Banking FinTechs, Knowing the Risk for the Reward. We're so excited to have you here. Before we dive into today's content, let's run through some quick housekeeping items. RiskOut will be sharing all of the webinar resources, including slides, handouts, and today's webinar recording in a follow-up email, so be sure to keep an eye on your inbox. We also want these sessions to be as valuable for you as possible, so we highly encourage you to ask any questions you may have throughout the session in the questions section of the webinar panel on the right side of your screen. We'll also be running a few polls throughout the session to better understand you, so your participation is greatly appreciated. For those of you that are joining us for the first time, RiskOut is a team of former bankers, regulators, and industry experts that have joined together to help community financial institutions unlock complex markets to increase deposits from their own backyards. Through both software and services, RiskOut reduces the time, effort, and uncertainty around expanding into new markets so you can increase your footprint without opening new branches. If you're interested in learning more, visit riskout.com and get in touch. To accompany this webinar, we developed a white paper entitled The ABCs of BaaS, a guide to banking as a service, to give you even more information about FinTechs that we won't have time to cover in today's webinar. If you want to see the statistics behind this growing market opportunity and additional guidance on how to vet partnerships and grow compliantly, visit riskout.com or grab the PDF right now in the handout section of the webinar panel on the right side of your screen. Growth. It's at the corner of every board meeting for every financial institution at one point or another. While there are tedious strategies like M&A and branch expansions, they aren't always a good fit for everybody. So how do financial institutions unlock non-traditional revenue that's already in their backyard while remaining compliant and safe? Join RiskOut's Kristen Parker next week as she leads a free webinar entitled Banks, Credit Unions, and FinTech: Increase revenue with non-traditional business to learn the various facets of launching a non-traditional business line. Register today. Today's session will be led by Kristen Parker, RiskOut's Director of Compliance, and Ryan McInerney, RiskOut's Product Strategy Principal. Prior to joining RiskOut, Kristen worked on both fraud and BSA teams, where she successfully created and implemented one of the first Federal Reserve Bank approved hemp onboarding and ongoing monitoring programs. Ryan McInerney joined RiskOut's product team after working as a national bank examiner with the OCC, where he helped to identify changing industry trends and risk conditions, particularly around compliance and commercial credit. We are so excited to have them joining us here today. And without further ado, I will go ahead and pass it over to today's excellent presenters to dive into our webinar content. Take it away, Ryan and Kristen.
Hi, everyone. Thanks for joining us today. Ryan and I are always excited to be here with you every month. We will hop right in because we've got a lot of slides to go through, but we do encourage you again to ask any questions you have throughout the webinar. We like to keep this engaging. On today's roadmap, we're going to be talking about the main point of this whole FinTech conversation. We're going to go through some FinTech statistics. We're going to be looking at the types of different FinTech relationships that you can have at your institution, what it takes to manage those FinTechs, and what it's like to assess the risk versus the reward of a FinTech relationship. So the main point of today that you're going to take away from here is to assess the viability of a FinTech partnership. You must understand the financial and operational impact of managing the FinTech. So these relationships, there are different aspects of these relationships that you must take into consideration from both the compliance and BSA side, but from the business development side, from the operational piece of your institution altogether. So we're going to be talking through all of those components today. Ryan?
All right. So starting off with the different type of FinTechs we're going to be discussing. So the first type of FinTech is a sponsor financial institution. That's a federal or state chartered entity that provides regulated financial services directly to the recipient. So we're talking about, in this instance, it could be indirectly or directly. If it's indirectly, we're going to have a slide later that's going to show you the differences between those, but basically how we're getting those consumers into our financial institution. And then it's typically reaching out to the FinTechs customer base or member base in other cases. The FinTech vendor user is a federal or state chartered financial institution that's going to be using a FinTech for an internal operational process. So it's not going to involve any money movement. And then the final example is the FinTech investor. And so a FinTech investor might be a financial institution that has undertaken the actual investment in a FinTech that's trying to solve a problem that they experience specifically, or they've joined some sort of fund where they are sponsoring the investment in different FinTechs that solve issues for a variety of different financial institutions.
Yep, and we're seeing a big healthy mix of all of these types of relationships in here. So at some point in your banking career, you are going to run into one of these three scenarios. So it's good for you to really pay attention, because whether or not you think your institution is in the space now or not, or are looking into the space, I guarantee you they're probably looking into the space. You're probably just in the BSA compliance world potentially that maybe you're the last to know. So it's good to pay attention here and get ahead of it while you can really beef up your knowledge on this space. So into the next slide.
Excellent, and that will bring us to our first poll question of today. And this one is actually a little bit of trivia. So we should see this poll question coming up on your screen right now. And that question asks, when was the first FinTech created? This is not as much of an opinion or a personal input, as much as we're just curious on how much our audience today knows about FinTechs. Here's a hint, the answer may surprise you. Let's give everyone another second here to get their answers in. Excellent. All right. I'll actually turn these results around to see where everyone landed. Seems like we've got the overwhelming majority thinking that it is very recent in 1966, and y'all will be surprised to learn that the answer is actually 1886. Option number B there. That year actually saw the development of the first transatlantic cable under the ocean, which would be used to enable the first electronic fund transfer system through technologies like Morse code and the telegraph. So definitely a little bit further back than the 1900s. I thought it was super interesting. And you know what? Now we all know. Thank you for your participation there. And I'll throw it back over to our presenters to give us a couple more fun facts about FinTechs.
Yeah, so it's really interesting when you start researching FinTechs and really the history of FinTechs, you really understand that it's, FinTechs have been around quite a long time. They've only ever blown up in the last, decade or so, and really in the last couple of years, we're seeing more and more institutions have to adopt into FinTech in order to keep up with the pace and be competitive in the market by offering quicker ways to move money, quicker ways to communicate with their institution, a whole different slew of reasoning. But just starting with the basics, let's just define what FinTech is. So FinTech, we talked about the three different categories that you typically see institutions participating in FinTechs as. But just to boil it down in layman's terms, it is a technology that is used to improve the delivery of financial services. It is there to move money faster, potentially offer other types of financial services to their consumers or their businesses at their institutions. There are varying other types of technology that are there to help, speed up the commercial compliance piece of maybe lending in mortgages and you name it. You can there's slews and slews and slews of different types of FinTechs. The projected value is about $324 billion by 2026. So the market is very valuable at this moment, but is only projected to get, more and more valuable over the next several years. And in 2021 alone, just so you guys are aware, there were about 9,000 FinTech startups. That's not including seasoned FinTechs that are out here, so startups. When you have a startup, sometimes it is hard for them to find relationships to work with institutions to help them facilitate their whatever their activity is. So it's really important for you guys to realize that, you know, not every bank is going to want to bank 5, 10, 20 FinTechs either, so, or credit union for that matter. So it's ripe with opportunity for these types of relationships who are seeking out financial services. And on the next slide, we'll talk about how it's important to the consumers. On the American side of the consumers, 9 out of 10 Americans now use some type of FinTech app to manage their financial lives. And surprisingly enough, it's the baby boomers that are the fastest growing segment by FinTech consumers. It's about the age 56 and older, their numbers are doubling year over year in their use of FinTech. And a lot of that happened during the pandemic as well, when they really didn't have the opportunity to go into their branches. Maybe they had to adapt into technology that they didn't really, a lot of them adapt into it, you know, just as time went on anyway. They might have naturally done it, but were forced into it quicker with the pandemic, as, you know, we didn't have the option to necessarily operate as business as usual if we were used to doing all of our business within an institution. The consumers have said that they have flocked there because it has saved them time, it gave them more control over their finances, and it saved them money. So more insight into their money and helping them move it quicker in between, you know, maybe potentially family members, maybe potentially their businesses, you know, all the different ways FinTech is used in these days. It has pushed towards about every American using some type of FinTech in their lives.
Yeah,
and
it's funny on that last one, you know, time is also money. So when we look at any of those, it's deriving some sort of value for the consumer. And this could be apps that are really tangential to financial institutions as well. When we look at apps like Truebill or things like that that help individuals manage their finances, it's not going to be something that's directly providing a service from a financial institution, but it's helping with the management of that actual individual's finances. So this goes into a lot of different potential areas.
Absolutely, yeah. So when this survey took place, 80% of the participants said it's important for them that their bank or their credit union account has the ability to connect to some FinTech digital app or services. So it's kind of what Ryan's point being, in fact, that, you know, it may not be money movement or something that's important to them in that facet. It's a way for them to be able to see what their livelihood looks like in one whole app and be able to manage you know, their flow of funds. 76% said FinTech connectivity was a top priority in choosing a bank, and 69% of them would consider switching banks if their financial institution couldn't connect them to a FinTech app, which I think is pretty telling. That it's not acceptable to most Americans that a institution, no matter the size, doesn't have some type of tech forward attitude that allows them to manage their lifestyle lifestyle and money that they in the way that they want to. Anything else to add, Ryan?
No, right. I mean, it's all pretty impactful numbers, though. It's crazy how important this has become and how fast it's become that important. When we would go to community financial institutions, when I was at the OCC, I mean, you saw this trend starting to come up more and more, particularly in more rural areas where maybe an institution hadn't made an investment into any FinTech or into any technological application for the consumers, because the demographic of the depositor base, the lending base started to age more and more. And then even then we saw that aging base start to demand that switch over as well. So it's really important for all consumers at this point.
That's a really great point, Brian. I think that's a great transition into our second poll question here of the day, which you should see coming up on your screen as we speak. And that asks, how important are FinTechs to maintaining your current deposit base? So we've seen these statistics pointing to America as a whole and how consumers are generally feeling about them. but we're curious at what it looks like at your own financial institution. So please select one of the following options, including our depositors would leave without FinTechs. FinTechs attract new depositors and they retain our existing ones. FinTechs retain our current depositors, but they're not really attracting new ones for us, or our depositors don't particularly care about FinTechs currently. We would love for y'all to give your input here. Looks like a lot have. I'll give another second. Excellent, awesome. Y'all are quick on the draw today. We'll go ahead and share these results out. And Ryan, I'm curious, you were talking about your experience back when you were an examiner, kind of seeing how these financial institutions were interacting with FinTechs across the country. Here we see that 79% of our audience claim that the FinTechs are attracting new depositors as well as retaining their existing ones, while 0% say that they're only retaining and not attracting. I'm curious, how does that kind of stack up to what you did see while you were with the OCC?
Yeah, I mean, it's kind of spot on. I know one of the particular examples I think of is when one financial institution was looking at their high school students going through, say, early 30s, and they expected those individuals to stay with the institution like their family had. I mean, this was generational usage of the institution, and they were starting to lose that part of the deposit base. And a lot of the biggest complaint there was they didn't have an application to manage their finances. So when they did put that app into place, they did see a stemming of the attrition that was happening with that deposit base. And it was also helpful for gaining new members of that community to go to the financial institution.
That's super interesting. I appreciate that insight. I'm also curious, 14% of our audience says that their depositors, frankly, they don't really care about FinTechs today. What is your take on that?
Yeah, I mean, there's definitely different parts of the country and different parts of the depositor base that's still the case. Depending on what they're using your financial institution for, they very well might not need a technical application, or they prefer that branch environment. So it's good to have options for both types of consumers and depositors, making sure they have that access to the technological aspects, but also having that in-branch, in-person feel, which is what kind of makes a community financial institution so important.
Excellent. Yeah, thank you for that. Always great to see how diverse of an audience we have on a call here. Appreciate y'all's insights, and let's get back to it.
All right. Well, with every new adventure becomes cautionary tales with it. So in the last year to 2 years almost, we have seen an uptick in FinTech sponsor compliance issues. So the compliance world is a little bit, what we've seen is in the BSA AML side, sometimes a little bit behind on what it takes to really run these relationships and run them efficiently and effectively. We see a lot of when the FinTech boom, really took off several years ago, and all these institutions like early adopters were the first to jump on it. And they just wanted to load and load and load and load and have, a whole vertical that was dedicated to FinTechs, which is great to serve these very needy type of businesses or need heavy for the financial services side. However, they didn't really take into consideration, and there wasn't a whole lot of guidance to begin with on how you should really be maintaining these relationships. These relationships, depending on how they're set up, trigger different requirements for your institution. Most of what we saw from the compliance sponsor issue was that the institution itself was too reliant on that FinTech that they knew what their BSA AML compliance responsibilities were. So some of these institutions, what they ran into was they had a signed agreement between the institution and the FinTech that said the FinTech was agreeing to take on all of the compliance duties, meaning, reviewing for suspicious activity, filing SARS, CIP, OFAC checks, watch list alerts, all of these things. And the institutions would get too comfortable in that signing of the agreement and didn't have really proper oversight over that FinTech to really ensure that FinTech was doing what they say they were doing. In the failure, the biggest failure we saw was when the OCC had to come in and shut down Blue Ridge Bank over that very issue. And the argument came back was, well, they signed an agreement that they would be reliable. At the end of the day, it's still your compliance program, your BSA AML compliance program. You are ultimately responsible at your institution for ensuring that all of your relationships are compliant, but especially these that there's money movement potentially involved in there. There's different triggers of BSA AML. There should be some suspicious activity, monitoring and reporting. Policy adherence is really the institution's responsibility. So they need to ensure that whatever that FinTech is saying that they're doing, they're actually doing, and they need to have a way to sample that that is actually occurring on some type of reoccurring basis. And they need to have escalation processes in place for times that these institutions do not, or these FinTechs do not adhere to their agreement, one, or the policy that they have written. Ryan, anything to add there?
No, that was comprehensive. I mean, you beat me and I'm the examiner on that one, so it's perfect. When we start talking more about some of these cautionary tales, so one of the things that we pointed out is a lot of regulatory agencies are starting to open some sort of technology oversight division. It's important to note that the OCC has already had something like this for systemically important technology service providers. So they've been performing exams on people like Fiserv or Iron Mountain, that sort of thing. And they actually, when I made this slide, they had just announced maybe the day before, they were opening a new division. That's the Office for Financial Technology. I think that's the name, don't hold me to that. But the idea behind that more than likely is going to be some sort of supervision over the technology service providers we're seeing that aren't the same scale as the core providers. It could also be just general supervision through financial institutions of the different FinTechs, but it's really a extension of almost the vendor management programs at the financial institutions. I would imagine the OCC is going to start trying to get more of an idea of what those relationships look like, and they'll start with the vendor FinTech relationships. There are some pretty good guidance pieces out there if you're looking for some of this stuff. So 2013-29, I believe, is the third-party risk management guidance, the original one. And then I believe it's 2021-9 is another piece of guidance that's on FinTech specifically. The second one I might be wrong, but it is in 2021 and it is bulletin. So, and then, Kristen kind of covered this already, but the Blue Ridge Bank incident, they believe they were covered based on those liability agreements. But at the end of the day, the FinTech is essentially an outsourced arrangement of the financial institution. And with that, they're basically considered a branch or a division of the FI, and therefore they are considered the same way as the FI would be. So anything they mess up on, whether that's BSA AML, whether that's disclosure requirements, if you hadn't been doing that monitoring appropriately and making sure that they're doing things within the way your policy would have stated, then you're going to be the one that's left holding the bag if something goes wrong. Anything to add, Kristen?
No, I think it's just important to know that, I kind of look at it, and because I've been a BSA officer a long time in my career, that we've been looking at money service businesses. If we're an institution that is properly banking a money service business, we're digging in a lot deeper on that money service business than we are maybe your typical C-store or run-of-the-mill business. It's thinking through that enhanced due diligence that you have to do in order to make yourself feel comfortable and safeguard your institution. So it does take a little bit of soul searching in there to say, okay, what is it that are the true risks of this partnership, and where can we mitigate those risks? So really, truly, a risk assessment is where your heart needs to be in the very beginning of these relationships. So you can really understand and dive into what do you have in place now that's going to help protect you, but what are you going to need in addition to that? Because you will need additional things in place, additional tools in your pocket to help you streamline those type of relationships and from the compliance review perspective.
Yeah, and so when we look at the strengths of financial institutions and FinTech partnerships, I mean, there's a lot of places where each one does really well. I mean, I'll throw out some for FinTechs. I know Kristen's gonna have a bunch on the financial institution side, but for FinTechs, for example, they're typically really innovative. They're able to build things a lot faster than we're able to do at a financial institution. So that speed to market is typically a lot better. And sometimes that mindset that's coming out of the financial services space and partnering that with financial services ideas, being able to have that third-party view gives us some new and innovative solutions.
Yeah, and on the financial institution side, the great thing about FinTech partnerships is that the financial institutions are typically, at least in their community, if not further outside of their community, are well-known institutions. So they have that brand and name recognition. They already have a customer base or a member base. They have, a wide variety of products maybe they already offer. They know the data based on their customers and what the customer offerings were. So there's a lot of things that a bank or a credit union can offer, but they don't move as quickly as a FinTech always, right? A FinTech has that tech stack, has that knowledge base, and it's just not, we just have to be honest and know that institutions don't typically have that same knowledge base there, the ability to move pretty quickly. I mean, I would bet to say most of the institutions I worked at were community financial institutions, and we moved kind of at the pace of a snail. We were always behind the bigger institutions, and the only way to keep up and provide our customers at the last institution I was at was to partner with FinTechs because they had the ability to move quickly. We knew what our customers were asking for, but we had no way to internally build that or do it quickly or efficiently, effectively. So the partnership between both parties was beneficial from keeping the customers happy. And the FinTech we know what the customers want, so we can help facilitate and kind of guide the FinTech on their offerings that we are partnering on.
Yeah. And when you get the two of those together, I mean, you have your understanding of your customer base, but now you have analytics that support that as well. You have maybe additional products, additional services, or potentially a way to offer your products and services currently faster. So there's that shared skill set really adds a lot to the total value you can deliver to your consumers at your institution.
Yeah, and I would always advise if you're getting into a FinTech partnership, like you need to have really truly a partnership with this FinTech. That it's not just a closed deal that when you sign the paperwork and you guys are all happy with how the technology is working, that's the end of those conversations, because things move so rapidly these days. Your FinTech partnership needs to be, they need to be able to be nimble and adjust to whatever your customer or member base is really demanding at the moment. That, if you have a partner that is just a closed door, we're just going to provide you what you need on a reoccurring basis, then that's something you should take into consideration when you're evaluating those partnerships. Really have those conversations about how does this work long term? How do we, help make adjustments based on the offerings that particular FinTech does provide to your customer member base.
All right, so I promised an example earlier, and I've made a bunch of flowcharts in here, which may come off as not that visually appealing to start, but I think it's the best way for us to kind of describe the differences between different FinTech relationships. So this one, we're talking a little bit about indirect versus direct relationships. When we're looking at a direct relationship, that's going to be on the top. Typically, that's when a FinTech is providing a prospect to the financial institution. Then that financial institution might be doing the due diligence and delivering financial services directly to the prospect or customer, member, whatever stage they end up being. On the indirect side, that's when the financial institution is providing the right to deliver services to the FinTech, at which point that means the FinTech is performing due diligence and they are the ones that are actually providing the services through the financial institution, but they deliver it themselves to the end consumer. And so we can go to the next slide on that one.
Yeah, so when we were talking about initially, okay, you've got to, as an institution, be able to ensure that the policies and procedures that this FinTech relationship has agreed to, and you guys have signed off on together, how do you go about collecting that information and ensuring that these businesses are doing what they say they are doing? These FinTechs are doing what they say they're doing, and for that matter of fact, that the FinTech's customer base really fits your own risk appetite that you also agreed upon. So there's really maybe a couple ways to skin the cat, but really the most efficient and effective way is to have some type of onboarding way to vet that FinTech before they start, memorialize the agreement that you guys have, and then have the tool in your pocket to be able to perform ongoing due diligence of that policy. You want to make sure that you have some type of reoccurring check-in, and it's best to automate that so that you can request maybe a certain sample subset of information that is based on whatever products that they're offering. So maybe you say, I want to sample 10% of the customer base that's using this FinTech. I want to know, I want to test their CIP collection, make sure that they are doing suspicious activity monitoring, if that's what you agreed upon, that they have reported anything up the chain that is potentially suspicious, that they have closed accounts or types of relationships that don't adhere to whatever policy and procedures. So numerous things you can ask, right? It's best to have some type of reoccurring check-in with them and to automate that so that that relationship becomes seamless in that compliance adherence model. And this is just a sample of how it works in RiskOut when that information collection is automated, right? So we have a way to request certain pieces of information in our system from that FinTech, and they can provide it back electronically, and that can be very seamless. You can also, in the RiskOut platform, have the ability to also have that FinTech use RiskOut and be able to, oversee that entire relationship within RiskOut. So you can go in and you could sample documents on your own without having to send them an information request on a reoccurring basis. We know that's probably a whole nother webinar in and of itself, but that's just one way to really ensure that policy adherence is occurring on a more rapid basis and a more streamlined, scalable basis.
Yep. And the reason we bring that up as a point is so the example we're showing is a vendor-user relationship. So these relationships where there's not money being moved, where there's not financial services being delivered, that's still a FinTech relationship. So you can think of RiskOut as one of those examples. You can think of Quantivate, for example, as being another one of those examples. But these are FinTechs that perform some sort of service or perform some sort of role that's maybe enhancing operationally, either for financial institution staff or for end consumers, but they're not actually delivering financial services.
Right. Well, when we talk about risk and compliance at your financial institution, we talk about the internal departments and where they all collide in needing information to ensure this is not just adhering to whatever the policies are from a BSA AML compliance perspective, but also from the strategic perspective of your institution and from the overall operational piece, right? So we're needing to be able to review reports on these businesses. We have the need to have some type of quality control and audit over these type of relationships. Ryan?
Yeah, spot on. I mean, when we're looking at it inside of the financial institution, we have the ability to do that easily. We can see it. So audit, quality control, they're going into our departments, and us on the risk compliance side, or even any sort of oversight, that's all visible. It changes when we start to get outside of the FinTech. So what you'll see next is if there's a gap, right? And with the FinTech, there's going to be a wall. Essentially, the FinTech is performing a service for you, whether that's financial services or the operational component, but now you're cut out of the loop and understanding what's happening. So, and as you'll notice, this is a Top Gun reference. There's a lot of these in here that I had to pull out because there were so many of them, but there's been some Easter eggs in there. So if you keep your eye out, there's more Top Gun references. But the idea here is now once we are the risk and compliance department, or even we're just oversight of a FinTech, how do we get that information over the wall so that we can analyze it and understand that processes are being performed correctly and that the risk level that's being taken by that entity is appropriate for what we have approved in either our risk appetite, risk tolerance, or our policies and procedures. So what we talk about next is managing from behind the wall. And I've never noticed it before, but this kind of looks like almost a scene out of Mario. So if we're looking on the right-hand side, what you're going to see is monitoring that can be performed without actually engaging with the FinTech. So you can monitor with negative news checks, background checks, OFAC checks, all of that sort of information you can gather independently. Now, what helps and what you're going to need from a regulatory purpose and even from an operational standpoint is performance monitoring. So how do we ensure that the FinTech is operating within the bounds that we would expect that we find to be permissible? Some of the things you want to be checking for on that are key performance indicators. We'll have a couple of examples of that on future slides. Audit and quality control. So maybe they're performing annual audits. Maybe they have quality control that's occurring every quarter. We should be requesting that sort of documentation, reviewing it and statusing it. And then lastly, did we put service level agreements in place prior to engaging with the FinTech, which I would highly recommend. And then are we holding them accountable to those service level agreements? If you put it in place, you really want to be checking that they're adhering to it. One of the problems with not checking is if you just kind of willfully ignore the process of keeping up on that, and they've been acting the same way for 4 or 5 years, you might question the legal enforceability of that claim, of that agreement, if you've been fine with them acting outside of the agreement the entire relationship you've been in. So you really want to make sure that they're doing what they're supposed to be doing. Anything to add on that, Kristen?
No, I think we can go to the next slide.
Okay, so here's an example that we've put together for you. So this is the example of an indirect auto relationship. So what you're going to see starting on the left-hand side is the FinTech, and then you have the FinTech reporting to your financial institution in these pink boxes. So on the top, maybe on a monthly basis, there's reporting that's coming to the financial institution that's describing the portfolio. So what's the level of delinquencies within the portfolio? How many originations have there been? And what have the payoff results been? By combining all that information together on a more frequent basis, we're understanding the level of risk that's being taken by the FinTech, and then we can take that in consideration with the risk that we take as a financial institution. Now, on the other hand, we're going to be wanting to look maybe on a semi-annual or an annual basis, what's actually happening with processes, what's happening with controls, are they operating within service level agreements? So we pull that information on a less frequent basis. Now, the financial institution is going to want to evaluate all of this information. So when we get towards the right-hand side, you'll see 2 gold, I guess we'll call those diamonds. We're going to evaluate, 1 is the portfolio within our risk tolerance, and then 2 are the processes acceptable relative to our risk tolerance and our risk appetite. If we're good on both of those, we document it. That's the end of our review, and we say, yep, we're good for another year, another 6 months, whatever it is with this FinTech relationship. If either of those aren't acceptable, that's when you want to put in some sort of remediation plan. 1, to either A, get the portfolio within the risk tolerance you find to be acceptable, or 2, if they're doing things that are outside of your policies, procedures, and they're really just not behaving, you need to put something in place with them, say, get this in check, or we have to exit this relationship because it's not acceptable based on how we want to operate as a financial institution. And by holding them accountable to that on a more frequent basis, then you reduce the risk of running into that situation. You really don't want to run into that situation when that FinTech has become systemically important to you. And if you've waited to do these reviews and you find out later when maybe they have this massive concentration at your institution, it's going to be a lot harder to unwind than if you'd been keeping up with this on a periodic basis as you grew the relationship.
Yeah, we have found that more oftentimes than not, a reoccurring check-in on some type of quarterly basis gives you the best pulse check you can have on these relationships on them. And so you really avoid that surprise. If you're doing something annually, you could very well be caught off guard by these, especially if they've had a shift in their own management or their own business plan that they have not shared with you. That's something that should be included in your agreement, is that if they have a key leader change or some type of business model change, that they are communicating that with you, and maybe a new agreement needs to be come out of that, or you just have a strategic check-in with that FinTech as well. Because again, if you go a year between evaluating these relationships, it could slap you in the face and be a big, big issue to have to unwind and unfold and then to eventually terminate.
And one last thing to think about with that too is if you're asking for this information, make sure you're reviewing it. So at RiskOut, we send out automated checkpoints, and that's what gathers information for the financial institutions that use our software. Those checkpoints go to customers or members. Now, when those checkpoints come back, those are used to inform a review. So typically they're relatively in line timing wise. But when we're getting that more frequent information, say like the delinquency statistics or something along those lines, you could set up some threshold to alert you when those pass the threshold. So you don't necessarily have to be checking that every time until it reaches a level that's starting to get close to maybe your policy limits or a threshold that you put in place that warrants review. But you don't want it just coming in and ignoring it. There should be some way to decision it and know what that information actually means to you.
Yeah,
That's
yeah.
a great
And I want to add one more thing, Ethan, real quick, is if you are collecting the information, you have to do something with it, like Ryan said, right? We are in the BSA AML world is totally guilty of thinking we need to police industries to the nth degree when we do need to be informed. We do need to have risk-based information collection and due diligence processes, but we don't need to collect the whole entire library of things that we're not going to do anything with and look at or understand, for that matter of fact. So I like to remind everybody that if you're collecting it, you need to be reviewing it, and you need to understand what you're reviewing it, because you can't just be checking a box for checking the sake of checking a regulatory box and then something blow up and you've said you've looked at it, but you had no idea what you were even reviewing. So it's good to reminder that, you know, there are folks out there that can help you navigate what information you should be collecting from these type of businesses and and help you understand what you're looking for and looking at and for potential red flags.
Those are great call outs. I really appreciate that. And I think it's a good transition into our third poll question of the session today. Should be coming up on your screen now. And that asks, what are the most important aspects for FinTech selection for your financial institution? What kind of data are you hoping to collect when you're starting to onboard that relationship? Now, this question does allow you to choose as many or as few responses as you'd like. So if there are multiple of these that are the #1 priority for you, do not hesitate to select all those boxes. And those options are cost, a culture fit, innovation, or experience of that FinTech you want to know about before entering into a partnership. Give you all another second to get your responses in here before we share out the results. Excellent, excellent. Thank you for all those that gave their feedback. Should be seeing the responses come up on the screen here. And as you can see across the board, you know, over half of our audience says that they're looking at all 4 of these options. That said, culture fit is the lowest, with only just over half of our institutions considering that a major factor in evaluating FinTech partnerships. The #1 of which is experience. What does their track record look like? How has this FinTech behaved in the past? And is it going to collaborate well with my financial institution? Kristen, let me ask you, how does this stack up to what you're expecting to see, or how you yourself might even look at your FinTechs as they were coming into your financial institution?
Yeah, I think this is right in line. I don't fault anybody for saying cultural fit as being the lowest, because sometimes, you know, the relationship can be great, and the idea of the partnership is you know, more of an idealistic thing, right? But the experience I see as being very important to some folks, right? You know, have some time under your belt as a FinTech. The problem is, you saw in the very beginning of this that you know, just short of 2 years ago, there was more than 9,000 startups in FinTech space. So not all of them are going to come with great experience potentially. So I want people to keep that in mind. when they're thinking through their FinTech partnerships. It's not necessarily the age of the company, it is also potentially the people behind the company. So you could have the age of the company being very young, just because we're in that phase right now of there being a lot of startups. But that doesn't mean that the folks behind that startup don't have the experience from other FinTechs that they've been at, from other experiences that they've had, that will help that FinTech be successful, and they actually know what their responsibilities are and can execute on their promises to your institution.
Well said. Thank you for taking the time to respond to that. I will go ahead and throw it back over to y'all.
All right, is this relationship worth it? Sorry, time will tell. Go ahead, Ethan. So what is the cost? So let me ask Ryan. Let's do quick rapid fire questions for Ryan. How will you periodically gather, assess, information from a FinTech, being the what?
Yep. So when we're going through that process, figuring out this is going to be my process with that FinTech, am I getting information via emails? Did I set up some sort of automated form that's going out to them? Am I APIing that information directly back to the financial institution? All of those things. How do I actually set them up? And are they going to work with that FinTech? Are they going to work with the technical expertise we have at the financial institution?
What is the cost to implement and maintain those processes?
Yep. And so on the cost for actually putting those processes in place, I think you go through the different options that you have. So am I getting forms? Am I going through the API? How much does that take time-wise? How much does it actually cost if I'm hiring, say, development talent, or maybe different development talent within the institution for processes, things like that, and mapping that out. So put that against each potential option you have for information gathering and figure out what the cost actually is to implement it, and then maintain it. I mean, if you need people to keep going through this, say every month, every 2 months, 3 months, what's the time cost to your staff? And when does that mean you need more staff or need to make a better process for getting the information when you scale up?
What is the reputational risk for my financial institution?
Yeah, I think this one's going to differ for each financial institution. So one of the examples I used is, say you as a financial institution have this massive portfolio of, let's say, municipal deposits. The municipal depositor requires you to have an outstanding CRA rating. You're fine with that, but they also care about the reputation of your institution. So maybe you enter into a space that's potentially a little bit more nefarious. Maybe you're doing payments for companies that are considered very high risk. So let's say explicit type companies, that sort of thing. That's probably going to be more risk than you're willing to take. So that's what I want you to be thinking about when you're saying, what's the cost of that reputational risk? What potential customers or members will it affect if this potential industry, potential FinTech goes the wrong way for us? And then what are our opportunities to replace maybe deposits, loans, or different processes if something does go wrong? Contingency planning is really at the heart of most examiners. We love contingency planning, so making sure you're ready for those potential scenarios.
How could this affect the profitability of the proposed and existing business lines?
I think I accidentally answered that in the first one, but I wasn't reading ahead. So that's how you guys know I'm not cheating.
There you go. Next slide. Is there a broader strategic reason for the partnership?
Yeah, so when we get further into the presentation, and maybe a slide or two, we'll talk about market sizing, that sort of thing. Why would we actually be engaging with that FinTech? What does it offer us financially? But there might be a different reason for going to engage with the financial technology company. It might be for stemming attrition. It might be for just catching up with competitors in the area. So some of these relationships aren't going to have a clear financial benefit immediately. So making sure that if you're entering into a relationship for the reason that it has strategic viability to you, but it's not profitable, that should be understood when you're actually pitching it, working with the board team, the management team. Because if it goes to somebody and they say, this makes us no money, well, that wasn't actually the intention in the first place. So making it clear what the intention is.
I think you answered the next one in that too. Can we accept a lower return or higher cost for strategic alignment?
Yep.
Yeah.
And I think, so if you are doing, so just to add on that too, for that accepting a lower return, higher cost, that sort of thing, Show different bands, different scenarios of how much it might cost you, because a lot of, I mean, we're in financial services. A lot of us are very financially minded. So what's the best case scenario? What's the worst case scenario? Even if it's not something that's going to be very profitable for your institution, it's still important to know what the potential results are, and people are going to care about that.
Yeah, absolutely. How does this partnership enable growth in other areas of our institution?
Yep. So let's say we are looking at adding new depositors. Say we're adding new depositors in a specific industry vertical. Everyone here loves cross-selling, I would imagine. And if you don't love cross-selling, you will learn to love cross-selling, because once we get maybe that new deposit base in, potentially 50% of them get loans, potentially 50% of them get payments. Maybe the referrals from those individuals get us access into new markets, new geographies, new industry verticals. So instead of just looking at that initial slice that you're getting into the program, make sure you're really considering what the broader impact is and how it affects you. It almost ties back to the broader strategic reason for the partnership, because some of that's not going to be quantifiable.
What is the total potential revenue generated now and or over the coming 3 years?
Yeah, I mean, I don't know what the actual revenue would be, so that's a good question to ask. But I think it's really important to show 1 year and 3 years, because you show 1 year and it's like, this is the cost it's probably going to be to us, because it's hard to get a program off the ground and very profitable very quickly. So making sure everyone in your institution is aligned on, this is the expense to us immediately, and this is what the long-term benefit is supposed to be. If you think you can feasibly map it out to 5 years, I mean, I'd say go for it, but so many things change in those timeframes. I mean, look at the past few months, we're missing banks, like literally missing banks. So tying out 5 years is probably a little bit difficult, but 1 year and 3 years, I think gives you a good picture of what's to come.
Yeah, absolutely.
All right. So we have a couple of slides in here just on the market itself. I think this is helpful if you're starting to pitch a fintech to somebody at your financial institution. We'll just run through quickly what these figures mean. You all will get the presentation so you can use this if you need it. But the idea, say initially, if you're entering into a new industry vertical, you're using, say, a fintech to go after auto loans, what's the total addressable market? You might say that's across the US. So I can make X amount over on auto loans in the US based on this fintech. Then you move to the serviceable available market. And so what that's going to mean is you take subsets of that industry. So you're interested in auto loans, but potentially you only like Chevys. Everyone at your financial institution refuses to drive any vehicle other than a Chevy. So you are only going to target Chevy dealers. So now you have that serviceable available market. And then the obtainable market at the end is going to be, of that specified market that I want to look at, how much do I feasibly think I can win for my institution? So that might be capacity limitations, it might be our staffing, it might be a geographical limitations, but you get down to that final market size, and that's the one that you start to build towards. This is what our goal is, and we think we can get here in X amount of time by doing X amount of things. Anything to add on that pitch, Kristen?
Nope.
All right, and so we'll keep going through on kind of the things that you should be thinking about when you're actually approaching the board, the management team, or potentially other individuals in the bank for building out these programs. So determining whether or not you actually need a fintech. Maybe it's a space where you need staffing. It's been very difficult to find certain qualified staff, particularly in different markets. So can you find the required staff to operate the program? Could the fintech potentially be a way to reduce that staffing burden? Or alternatively, do they add so much work that they actually increase the staffing burden you need? So making sure you understand how much you're going to need on the staffing side, and if it's up or down, how do you acquire that talent?
Yeah, and it's really important to walk through, an ROI calculator in that scenario too. That is really robust in the fact that it helps you understand what the tasks are going to be to maintain these relationships. How long do they take to do for each type of relationship, and how many customers or members you can have in your portfolio until you trigger that need for another employee. There's some good hard thinking math that goes into that, but it is really worth it to understand so that you start out your program from the very beginning, understanding what your more than likely your staffing needs, or when you're going to be triggered for additional staffing or technology or both. So your board is well educated on that. It's by no surprise.
So the next piece we think about is the actual cost of the financial technology solution. So there's a lot of different ways you might be charged for using the entity. It could be on a per entity basis. So you have different customers or members coming through, they're charging you per entity. Maybe they're charging you basis points on some sort of lending spread, or maybe payments, basis points on those payments. So offsetting that technology cost with the required full-time employee salaries and the revenue, that's how we're going to finally get to that profit line. But is the FinTech actually scaling with you as you grow? So are they charging you the same basis point spread in perpetuity, regardless of the size of your program? I mean, as you get larger, it's probably a good idea to try and bake in some sort of tiering, saying, you know, I'd really like this to be a little less expensive once I'm providing so much through you and you become so important to our company. There could be other reasons they're scaling. So maybe they have a minimum, but then after you've passed that minimum, it's a lot less expensive for you on a per unit basis. So just make sure you understand that pricing structure holistically, because some of these relationships might look less expensive than they are, but there might be other factors that are in there that are actually charging you more money than a competitor. You really got to look at that lifetime cost of different FinTech relationships when you're comparing them. It's not always as simple as, yeah, this is the cost we get charged per year. Make sure you're looking at all like kind of like ways people are tricking you into paying more money to them.
Mm-hmm.
This is probably everyone's favorite one, is the profitability. So when are you going to break even? Have you communicated that really clearly to the stakeholders at your institution? Is it year one? Is it year two? Is it year three? And if you don't hit the goals that you're trying to hit, when do you say, I'm done with this, I'm going to leave, I'm staying single, I don't need this relationship? So at a certain point, there's a drop dead point. Make sure you put that kind of together before you start the relationship. It's like if you go to a casino, you brought X amount of dollars with you and you don't bring your debit card, so you don't go back to the ATM and keep going. There's going to be a year, maybe a month, that you say, I'm done, I'm out. Or there's going to be maybe a total loss that you had to, and we say, we're done, we're out. Or maybe we're renegotiating with the FinTech because they probably don't want to lose the relationship, and you can show that it really hasn't been beneficial for you. So just making sure you've really established what the point is for you to quit.
Yeah. So when it comes to managing your FinTech, you definitely want to be performing a detailed onboarding and have a reference check. So ensuring that your FinTech is not just saying they are who they are, that the proof is in the pudding, and if you're their first institution that they've ever worked with, then you have to do a little bit of extra due diligence. You've also got to have, your ducks in a row in regards to your agreements. Sometimes the agreements say we'll give you, 1 year to prove your concept here, but the check-ins are more regular. You want to collaborate with the FinTech on their policies and procedure expectations. That includes them adhering to at minimum, your policies. They should have their own policies. You should have some type of reoccurring process with them to ensure that they are actually following their policies. You want to consistently monitor and review for policy adherence, what we just talked about, and you want to make sure that you have all of this documentation of what you've been reviewing to ensure that FinTech is doing what they're saying do in a legible and digestible manner for your auditors and regulators, because if it wasn't documented, it didn't happen.
And things you shouldn't do. I mean, don't stop performing ongoing due diligence. I think we've kind of beat that over the head, but if you stop, that's kind of how you get into a lot of this trouble. And don't make assumptions about the entities that you're trying to engage with. I mean, Kristen made the point of the 9,000 FinTech startups. One of the stats we used in a crypto webinar was at one point, I think there were 15,000 coins that were in circulation. Like 6,000 of those were already defunct. So you look at kind of how many of these start and then fall off. It's really not a situation you want to find yourself in. So make sure you've really done that proper vetting. I think there was a quote, and I could misattribute this quote, but it was Warren Buffett. And the line was, when the tide goes out, you can see who's wearing pants. And that was in relation to the initial coin offerings and the coins that all started to shut down. Also in relation to a lot of startups that were just getting funding and then didn't really have a product or an idea that was viable at that point, and then they kind of get lost and they wash out. So don't make assumptions, make sure you understand, trust but verify, that sort of thing. Really important.
Excellent. Love that quote, and very excited to get into our questions here. Again, if you have a question that you'd like to ask, feel free to do so in the right-hand panel we have on the side of our screen here for our panelists. I know we're running short on time here, so if we don't answer your question today, we'll be sure to follow up with you after today's webinar to ensure you get the answers you need. As we are asking some questions that we've gotten throughout the session, we do have our final poll question of our webinar that should be showing up on your screen now. Feel free to take your time. This is an optional question, but would love to know if y'all are interested in getting in touch with RiskOut about FinTechs or anything else that we're happy to offer. Let's see, Ryan, we did get a question that came in about something that you commented on earlier in the session, stating if our agreement with a FinTech states that we're able to exit a customer at any time for any reason, why would it be more difficult to untangle that FinTech relationship further down the line than at that starting point? Would you mind providing any clarity on what you meant?
Yeah, sure. I mean, if you have that line in there, that's great that you want to be able to exit those relationships. From a reputational perspective, if you have this large portfolio and then you just cut off all services to them and kick them out the door in say 1-2 days, it's probably going to be a pretty unpleasant experience for you from say a news media perspective. There could be other situations where maybe that process isn't just a consumer process. Maybe it's the FinTech is part of some workflow at your institution. At that point, you've got to say, what are the different ways that I now plug that gap and I fill that workflow with some sort of different vendor or internal solution to make sure that we don't drop the ball and miss what we're trying to do. And that could go across maybe like disclosures that are being sent out or anything like that.
Thank you. I appreciate you shedding some light there. Again, if we weren't able to get to your question today during today's webinar session, we'll be sure to follow up with you after the session. We love reaching out, getting in touch, and answering any questions that you might have, whether or not we talked about it on today's webinar. That is all the time that we have for today. I want to thank everyone again for joining us, and a huge thank you to our presenters for sharing their expertise with us during today's webinar. Please keep an eye on your inbox. RiskOut will be sending the recording, the slides that we saw today, as well as all of the resources from today's session for your convenience. So be sure to keep an eye out for that. And if you do have any additional questions, comments, or concerns, if you want to learn more about RiskOut, or if you just want to say hi to your presenters, please don't hesitate to visit us at riskout.com. We hope to see you next month. Thank you all and enjoy the rest of your day.